Right now, though, to talk about the market implications, Saira Malik, Chief Investment Officer of Nuveen. Good morning to you. As we're all trying to await this number, does it come in hot? Does it come in cold? What is just right, Saira?
Well, markets are anxious over two events this week. One is CPI, and the second is earnings. With CPI, we did see anxiety yesterday with momentum stocks unwinding, and I think the line is going to be drawn at about plus 0.3% month over month for headline and core. If we come in below that, I think markets will rally, but above that, I think this preprint rally that we're seeing will decline. We're going to be watching airfares and also shelter and autos. Those are the three areas that have been hot and sticky in the past with inflation, hoping to see those decline going forward. Also now switching over to earnings, which I think could be more of a positive for the markets, looking for revenue and earnings growth of about 3% for the first quarter. When we see that, I think what we want to see with earnings, though, is some broadening out. So earnings will be led by tech stocks with the best earnings numbers, but we want to see some broadening out in material sectors and even energy sectors, which have been laggards in terms of estimate downward revisions. If we can see that, I think that'll be what will be the catalyst that takes the market above 5,200, which, as you mentioned, has been a struggle and a line for the markets as we wait to see if inflation will moderate.
Are you in the camp of 2 rate cuts, 3 rate cuts, no rate cuts?
We've been pretty consistently in the camp of 3 rate cuts, and we haven't changed that. But if I had to bet, I'd come in under when it comes to that, because already inflation is not showing signs of hitting target. And the other side of this is that the economy is strong. It's been driven by strong employment markets, a consumer who continues to spend, and also manufacturing data that just recently moved into expansionary territory. We haven't seen that since fall of 2022. I just don't see the Fed having any risk to rush here. I think as the year goes on, June cuts are already less than 50% chance of happening. If we don't see one in July, the Fed tends to do less as we approach the election. So, 1 to 2 rate cuts could definitely be on the table for this year.
If you're right, a bullish call on equities, is that also right? Because you could argue we're going to have a strong economy, but you could also argue that this whole market is based on at least 3 rate cuts right now, and there's sort of bullish sentiment that the Fed is going to lower rates.
Well, it's interesting because we came into this year and the market was bullish based on 7 rate cuts, and it's handled it very well, that decline to 3 rate cuts. The key for this bullish market is going to be, can the index participation broaden from here? In order to do that, we need the economy to remain strong. Can tech continue to lead this market a little bit higher? Sure, it can. But I want to see participation from other areas, such as materials, such as energy stocks, other areas that are more economically sensitive. That's going to be the next leg that drives this market higher. 1Q earnings are going to be give us some nice visibility into that. I think the 3% revenue and earnings growth is probably on the conservative side. Companies can beat that. Expectations are for margins to be flat. I think companies may be able to beat there. That's going to be the key that tells us, can the market move higher? I think CPI is going to be just another data point that makes the Fed not really change its mind, and 3 rate cuts will be the maximum.